Janet Yellen, who's been nominated to succeed Ben Bernanke as head of the Fed early next year, is expected to continue the Fed's current stimulus. Now, although there is talk of Fed tapering and concern that the market may be overheating, we are not seeing any real signs of this based on today's trading. And for his take on the markets, we're now joined by Bill Strazzullo, partner and chief market strategist with Bell Curve Trading. Hi, Bill. Thanks for joining us again.
Great to be here, Michelle.
Bill, is this market overvalued? We've got lofty stock prices. Some investors say the market is becoming too expensive and that the risk of a sell-off is increasing. What do you think?
Well, I think what's important, Michelle, for the viewers to keep in mind is that I think the next couple of months are really going to set the stage for what happens in 2014. If you take a step back and you look at this rally, you can trace it all the way back to March 2009. That was in the depths of the financial crisis. Not only U.S. equities bottom, but basically global equities. You fast forward and you look at this rally, there were two major obstacles that the market had to overcome. First was around 1550 in the S&P. That ties in with the top in 2000, the dot-com bubble, the top in 2007, the housing crisis. We got above that. And really the last hurdle is right around here, 1750, 1800 in the S&P 500. So as we go into next year, we know that there are going to be some challenges right off the bat. You're going to probably have another budget skirmish in January, February. I think the conversation about tapering is going to become a reality in the first quarter. And then lastly, I think there's going to be a heightened awareness with regard to all the economic data, simply because this is the first time the Fed's actually thinking about reducing monetary stimulus rather than adding to it. So if we have this conversation in January or February next year and the market's still trading at these levels, I think we're in really good shape. If you start to see the market roll over, get below 15,500 in the Dow, 1,700 in the S&P.
So Bill, given your concerns, are you saying it's time to pull out? If you're saying we've got all of these challenges that we face in the beginning of next year, do you think it's time to take some money off the table?
I think, Michelle, we need to see what goes on over the next couple of months. I want to see how the market can deal with the prospect of tapering. I think that's going to be a first quarter event. I want to see what happens with the budget negotiations. And again, I think if we can hold these levels, we're in really good shape for 2014. If we start to roll, and you know, the yardstick you want to look at is S&P below 1,700, Dow below 15,500, NASDAQ 100 below 3,200. You get below those levels, I think that's what tells you you've got to begin to play some defense and reduce your equity exposure.
Well, in the meantime, activist investor Carl Icahn says that he's very concerned about the stock market and that he sees a big drop because earnings at many companies are fueled more by low borrowing costs than by management's efforts to boost results. We've had several earnings seasons where the prevailing trend is lower revenue, but profits have beat. So what do you make of Icahn's statements? How much of an issue is this?
I think it's a very legitimate concern, Michelle. Look, when you look at the market every day making new highs, Dow, S&P, and NASDAQ climbing back from its trough, and then you look at and you compare that with what's going on in not just the U.S. economy, but the global economy. I mean, U.S., you know, we've got GDP growth around 2%. The Eurozone, we're basically flat. China's had a pretty significant deceleration. That doesn't tie in with markets that are making new highs every day. So that difference has to be reconciled. Either the world economies, U.S., Europe, China, are going to begin to reaccelerate, or the equity markets have to trade down to reflect what's really been a sluggish global growth. And so if we don't start to see the global economies pick up sometime, I think in the first or second quarter, the way that's going to reconcile is I think you see a pretty significant down move in the equity markets around the world.
Well, Bill, one other big concern has been, other than the Fed that's pushing this rally, is that it's also been fueled by companies buying back their own stock. In fact, according to Reuters, stock buybacks are 93% higher than the average for the past 10 years. What happens when these companies stop buying back their own stock?
Well, first of all, I don't think that's necessarily a good sign. I mean, if you own the stock of a company, you'd rather see them take their profits and invest in the business. open new plants, buy new equipment, hire new people. The fact that they're engaging in stock buybacks at really unprecedented levels tells you that they don't have a great amount of confidence in terms of investing in that business in the future. So I'd actually like to see less stock buybacks. Take that money and invest it in the business. That, to me, would actually be a very positive sign. To continue to have these massive level of buybacks, to me, is a sign that the people, the CEOs who are running these companies, don't really see opportunities in their own businesses.
Bill, ultimately, whether she continues it for a little bit longer or not, Yellen is expected to scale back the bond buying program at some point next year. So what impact is that going to have? Are there any sectors that are going to be resilient to any form of tapering?
Yeah, I mean, that's a good question, Michelle, because that really is what this first quarter challenge that I referred to earlier is all about. I want to see how the market deals with that. I agree with you. I think the first quarter you're going to see the tapering. I want to see how the market holds up. If we get below those critical levels and the market starts to roll over, then I think you want to play defense. I like, in that scenario, I like large cap pharma. I mean, I think that'll be a place to weather the storm. I like consumer staples. You can look at the ETF XLP. That would be another place. Utilities as well would be another area where you could probably ride out a storm. And so that, to me, is really kind of the critical challenge that we're going to deal with in the first quarter of next year. When the Fed begins to taper, and I do believe it'll be sometime in the first quarter, how does the market react to that? How does it hold up? And again, I'd reference those key levels for the people watching the show. Right. You start to see the Dow below 15.5, S&P below 1,700, NASDAQ 100 below 3,200. You want to watch out, be careful, because that's a red flag that the market's beginning to correct.
Bill, we've got those technical points that we're going to be watching out for. The Fed tapering, that's also a concern. Other than that, what is the biggest risk to the market right now? If you're talking about on a macro basis, take a step back, Michelle, and think about the fact that we have, and when I say we, I mean the central banks around the world, governments around the world, have spent trillions of dollars to try to reinflate the global economy. What has it done for us? As I said, right now, GDP growth in the U.S. is 2%. I mean, in the Eurozone, it's basically flat. In China, it's decelerated to around 7.5%. If these measures don't work, the quantitative easing and the zero interest rates that we've seen for the last several years, there's really no more rabbits to pull out of the hat. What do we do if the economy begins to decelerate? That, to me, is what every central bank around the world is worried about. Having no more arrows left in the quiver, that's a big concern, as you pointed out. We're going to have to leave it there. Bill Strazzullo, thank you so much.